Welcome everybody to today's webinar about understanding the Main Street Lending Program and funding forward. Please post your questions in the Q&A only. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. Later in the day, we will also email a copy to participants. Briefly about myself, I am the founder and CEO of MultiFunding. We've been helping business owners for over a decade get the best possible loans. I'm an ink columnist. I've advised the prior administrations, the Treasury Department, as well as the Federal Reserve on business credit markets. I'm an author of The Growth Dilemma, and I'm an EO board member of Entrepreneurs Organization of Philadelphia. My lawyers asked me to share some disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for us to be thinking about what is next in our business. We are preparing for a battle as our companies and our country and the world reemerges and still struggles with COVID-19. What will our strategy for our businesses be? Will we pivot 5%, 50%, or 90%? What will our team look like going forward? And what will our ammunition be for this battle? And in this case, ammunition is cash. How much cash will we need for defense? What will be required to get your business back up on a stable footing? What is the best case and worst case scenario, and where will this cash come from? And what does your future look like, and what are there things to ponder? These are the contexts that I want you to think through the Main Street Lending Program as we describe it to you today. $600 billion is allocated towards it. It is in effect until September 30th, 2020, and is comprised of 3 facilities: the new, the priority, and the expanded. I think some context is important for all of us to consider. This program is not an entitlement program like the PPP. They are loans and you have to pay them back. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank. And if you plan to use a Main Street loan to expand and grow, more banks will be open to you. The program is live and getting going. Most banks are finally up and running this week and underwriting files. The Federal Reserve has issued a list of lenders on their website taking new borrowers. This list is not 100% accurate or complete. And everyone needs to keep that the program expires on September 30th. So if you plan to participate in the program, while we're hopeful that they're going to extend it, we're not sure. So everyone needs to hurry up. Existing lenders will consider adding additional debt to give their companies more runway and protect their current liabilities. So if you have loans with an existing lender, they are most inclined to give you a Main Street loan if you're qualified for. New lenders will be looking for strong credits and new banking relationships. If you're looking for a new lender and a Main Street loan, you'll almost invariably have to give them your banking relationship. And there are about 400 banks, to the best of our knowledge, participating or planning on participating in this program around the country. To be eligible, your business must be established prior to March 13th, 2020. If you have more than 15,000 employees or $5 billion of revenue, you're too big, and you have to be created or organized in the United States. U.S. eligibility test is you must have significant operations in the United States with the greater than 50% of your assets, annual net income, or annual net operating revenues generated in the United States. If you are a subsidiary of a foreign company, you can apply. However, you have to attest that none of the money will go offshore to your parent. Eligible companies for the program we're describing today include partnerships, LLCs, corporations, associations, trusts, cooperatives, joint ventures with no more than 49% participation by foreign business entities, or tribal business concerns. There's a new program which nonprofits can use, but that is not what we're discussing today. Ineligible borrowers include developers and landlords and other industries that are unique and therefore, or really speculative in their nature, such as private equity companies that are not eligible to participate. Affiliated groups of companies, so if you are part of a group of affiliated companies, you can participate, but the group as a whole has to share one Main Street facility to participate in, and the affiliated group cannot exceed the maximum loan amount for that facility. Now let's dig into the new and priority facilities. They share some commonalities. They are secured or unsecured term loans with a 5-year maturity. Principal payments are deferred for 2 years and interest payments are deferred for 1 year. The unpaid interest will be capitalized. You pay 15% at the end of year 3, 15% at the end of the year 4, and 70% at the end of year 5. They are priced at an adjustable rate of LIBOR plus 3%. So currently you can plan on paying around 3.25% for these loans. Prepayment is permitted without penalty, and the fees to get in are 1 to 2%, but almost invariably will be 2%. So let's talk about the new facilities and how they work. These loans are between $250,000 and $35 million. Let's take as an example row number 3. These loans are 4 times your 2019 EBITDA minus existing debt. So in row 3, a company with $500,000 of EBITDA, the maximum new loan facility they could get would be $2 million. If that company had existing debt of $1.5 million, they could get a potential new money loan of $500,000. That same company in row 1, if they had $500,000 worth of existing debt, they could get a potential new money loan of $1.5 million. What's important here is if you have existing lenders, those lenders have to agree with your new lender to share rights and assets if your company goes bankrupt. But the rights of your existing lenders can be senior to your new lender in the ordinary course of business. These loans can be secured or unsecured depending upon what you agree to with your lender. And you are allowed to take on additional debt after you get the loan, as long as it does not interfere with the rights of your lender. The priority facilities are between $250,000 and $50 million, so they go bigger. These loans run at 6 times your 2019 EBITDA, not 4. So if you take in row 3, that same company with $500,000 of 2019 EBITDA, they could get as much as $3 million. That company had $1.5 million worth of existing debt. They would get a potential priority loan of $1.5 million. If that same company had $500,000 worth of existing debt in row 1, their potential priority money would be $2.5 million. What's unique about these loans is you can refinance existing debt into them as long as it is not with the lender that is going to issue the Main Street loan to you. And the lender's rights have to be senior or on par with all your other lenders except for the mortgages in all times, in good times and in bad times. And these loans can be secured or unsecured depending on what you work out with your lender. Expanded facilities are different. They start at $10 million and they go as high as $300 million. To calculate them, to say as an example in row 2, a company with 2019 EBITDA of $10 million, the maximum expanded facility they could get is $60 million. If their existing debt was $50 million, their potential expanded money would be $10 million. These loans, rights of these loans tag along to the rights of your existing lenders, and they share all other attributes as the other loans, except the fees to get into them are a little smaller. While you have any one of these loans, new, priority, or expanded, you agree to not pay old debt off while you have the loan before you pay this debt off, unless you're making your ordinary payments. You commit not to reduce your standard lines of credit, and you attest that you have reasonable grounds to believe that your business will not go bankrupt in the next 90 days. While you have the loan, you can repay a line of credit, including a credit card in the ordinary line of business, You can take on additional debts as long as they do not interfere with the rights of your new lender, and you can refinance maturing debt. You agree to certain compensation restrictions while you have the loan and for 1 year after them. There are exemptions for S corporations or tax pass-through entities. While you have the loan for up to 12 months after the loan is paid in full, you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you agree not to make more than that while you have the loan and for 1 year after. For those who earn more than 3 million, say you earn 6, what you do is you take the difference between 3 and 6, you divide that in half, and your cap would be $4.5 million. You agree while you have the loan to make reasonable efforts to retain your employees, but this is not nearly as strict as the Paycheck Protection Program. Your lender will calculate your EBITDA. If it is a lender you have worked with historically, they will calculate it in the same way as they have historically calculated EBITDA for you. If they have not worked with you, they will have to do it the way they've calculated EBITDA for a similar company like yours before. Your debt will be calculated on the date of your application and will include all existing outstanding and undrawn debt from banks and private lenders alike. If you have an asset-based line secured by accounts receivable and inventory, your amount of debt will be calculated on what is available that day, not to borrow, but how much you've actually borrowed. How do you pick between one of the three? Well, to take example 2, a company with $4 million worth of EBITDA and $10 million worth of existing debt, they could get a new facility of 6, a priority facility of 14, or an expanded facility of 14. And they would have to sort out what they wanted, what their objectives were, and what their banks would be willing to let them do. Financing strategy is like playing offense and defense, and you need to think about both in the context of your loans. Example number 1 is a company who are planning on using Main Street loans and are in the process of applying for them. Is a company with a $3 million line and $1 million drawn. They're planning on getting a Main Street lending program for liquidity. They would rather not draw down their entire line. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much will be required to get your business back on a stable footing? What is the best case and worst case scenario? Where will the cash come from, and how will you fund it? And what does your future look like, and what opportunities do you want to consider? That is the end of my formal remarks. And now I'm going to invite you to share your questions in the Q&A, or it's a small group, so even if you want to raise your hand in the chat, that's okay, and you can ask them live. Moderator Hannah will now be happy to take your questions. Thank you, Hannah.
Thank you very much, Ami. All right, the floor is open, everyone.
And you can feel free to post your questions in the Q&A, or if you don't feel like typing them, go ahead and raise your hand, and we'll give you the option to speak in the chat box.
What about the Express?
David, that's really I'm assuming you're talking about the SBA Express lines of credit, and those programs are available. Sometimes it's the best, others it's not, and it's really depending on what you're trying to accomplish. Boy, you're a quiet group today.
How do we find the banks that are participating?
Neil, there's a list of banks that are participating on the Federal Reserve website. Our experience is that list is not complete and not 100% accurate. And we certainly also are working off a list for our clients as well.
What if you did not have EBITDA in 2019 due to a non-recurring charge?
It really depends on 2 things, Don. One is, what did your EBITDA look like excluding that non-recurring charge? And then are you going to a lender that you've used before or a new lender, and how does that, what is that bank's policy about considering that non-recurring charge as part of EBITDA?
Do you help get these loans?
Neil, we are working with with clients across the country to help them get these loans, yes. You're a very quiet group today. Neil, if you're interested, the email address, ami@multifunding.com, and you can reach out and we can schedule a consultation to see what your needs are, what it looks like, and if we think it makes sense.
I thought you earlier told us of an MSLP loan for $150K versus the $250K minimum you are now listing. What about the $150K for the Express?
Yeah, David, I think you might be getting them confused with the Express. So here we're talking about the Main Street lending programs, and then there are Express loans that are a line of credit by the SBA that are very different. So I think you're comparing apples and oranges.
I assume it is okay to share the recording with others who may be interested?
Of course, anytime.
For outstanding debt, can you confirm that this would include drawn line of credits, open credit card balances, and PPP?
Correct. I think it's also pretty clear, at least from how we're experiencing this, that it doesn't really make much sense to do one of these for anything less than $1 million. That there's just way too much work and paperwork involved in them. That if you need less than $1 million, there are probably other programs like the SBA program that will make more sense for you.
People like your background. You are a fighter pilot in these times, Ami.
I try to keep everyone smiling and try to keep my juice going. So, welcome any other questions, folks, through the chat, or you can raise your hand in the Q&A, whatever. Raise your hand in the chat or ask questions in the Q&A, whatever you like. Okay, we're going to go once on questions, go twice on questions, or thrice on questions. We thank you very much. You will get an email with this recording a little later today. We wish everyone Godspeed, and if we can be any assistance, please let us know. Take care now. Bye-bye.
Thank you.
Thanks.